Welcome to the latest episode of Quest for Twice. This is also the last episode for this year. I'm excited to provide the second half of the year-end review. I will cover what happened in 2021 and make predictions about 2022 and do my portfolio analysis. So as of December 14th, S&P 500 return was 25% versus my personal return of 63%. In the last week, my portfolio did worse than S&P 500, so it came down from the number I reported previously. What's more interesting is to look at the S&P 500 PE ratio. So this graph on the left shows the PE ratio from 2006 to 2022. The earnings in 2021 and 2022 are estimates. So I used the trailing 12-month earning as the denominator, with the exception of 2020. Because of the pandemic, the earning in 2020 was significantly less. However, because stock market discounts the future, so I felt it was more appropriate to use the estimated earning for year 2021, estimated at the end of 2020. And for the PE ratio at the end of 2022, I assume the price is the same as today. So what we can see is the PE ratio has been elevated in the last 6-7 years. The historical average is between 15 and 18, depends on how many years you go back to do the average. So as I mentioned, the 2020 PE ratio was using the estimated 2021 earning. So S&P 500 increased by about 25% in 2021. How come the 2021 PE ratio is almost the same as the PE ratio as 2020? Because they use, in theory, the same earning estimate. The answer can be explained by the graph on the right. So the dark blue line is the 2021 earning as a function of when the earning estimate was made. The light blue line is the 2022 estimated earning. So what we see is that from January 2021 to November 2021, the earning estimate has increased significantly. That earning estimate increase basically matches the S&P 500 return. That's why the PE ratio stays about the same from end of 2020 to December of 2021. We also see that the earning estimate for 2022 has also increased. Now it's about 10% higher than 2021 estimated earning. And for that reason, because I'm making the assumption that the S&P 500 price will not change in the year of 2022, then the PE ratio would come down by 10% because the denominator would increase by 10%. So in summary, what happened in 2021 was a PE ratio stay elevated, and the S&P 500 return was supported by the earning growth. So what will happen in next year? Here are my predictions. So for economy, I'm confident that the economy will stay vibrant, and there is no reason to doubt that the current strong housing market will not continue. Right now, there are a lot of talks about the inflation and the 10-year Treasury yield. I think it's very difficult to predict what the inflation and the yield will be in next year. So I don't have any prediction. With this context, I can see broadly there are two scenarios may play out. The first scenario is a risk still on. That's reflected by the high PE ratio that's above historical average. In that case, the market return will again be driven by earning growth, and that's about 10% based on the current estimate. The second scenario is a risk off. So in this scenario, the PE ratio will contract, for example, to 18. Then even with the earning growth, that will correspond to 15% market decline. Currently, the growth stocks are more richly valued than value stocks. Therefore, I believe they are more vulnerable than value stocks. As a result, under scenario number 2, those high flyers in the last 18 months probably will be hit harder than the value stocks. That's why there are key indicators to watch, including Tesla, which is the poster child of a high flyer, and ARK Technology ETF. Another one is Apple, given the significant run-up in Apple, as well as its huge market cap. Another one is Bitcoin, because that is the ultimate risk-on asset. And finally, 10-year Treasury yield, because currently the high value level in the growth stocks are justified by the very low 10-year yield. So if the 10-year yield rises significantly, then that justification is taken away. That will not necessarily trigger the significant PE contraction, but it is a strong possibility. So that's why it's important to watch the 10-year yield in next year. Now it's time for my portfolio analysis. So there is a lot of information on this slide. I listed my main holdings, and the columns from left to right has the information about the ticker of the company, and the weight in my portfolio, and the valuation level, mode of that company, and my prediction of the stock performance in next year for those two scenarios. One is risk still on, the other one is risk off. Finally, I also document my conviction of my predictions. So for cash, it's currently weighs about 0.3%, so not much. But it's important to use it as a baseline, because for the risk-on scenario, because the earning growth and I assume the PE ratio will stay the same, I think it will be underperform the market by 10%. For the risk-off scenario, as I mentioned, the market may decline by 15%. Then the cash will outperform the market by 15%. My conviction of my predictions for cash is low, because market can behave differently from what I described early on in those two scenarios, and even for and especially for risk-off scenario, market may get into a very violent, significant drop. For Aqua, its current price is $110-ish, and 42% of my portfolio. As I mentioned in my deep dive about 2 weeks ago, its EV over EBITDA ratio is about 8.8 using the adjusted EBITDA. Its mode is narrow, again, as I analyzed in my deep dive. I believe the stock will outperform the market in both scenarios because one is currently undervalued, two, there are a lot of earning growth potentials ahead of the company, and I have a high conviction. Next one is energy transfer. It's currently 14% of my portfolio and yields about 7.4%. What's more important is to look at the DCF yield using the 6 billion as 2022 DCF. So that yield is 24%. As a result, energy transfer will have a lot of cash that can be used to buy back stocks or units, as well as increase dividend. So I think it's significantly undervalued and will be able to outperform the market in both scenarios, and I have a high conviction in my predictions. For Kinder Morgan, it has only 3% in my total portfolio. Its yield is 6.8% and the DCF yield is 13%. And has a narrow moat according to Morningstar.com. So because of the about 7% yield, and I think it will be able to keep up with the market in the risk-on scenario. So I put an equal sign, that means just a market performance. For the risk-off scenario, because of the high yield, I think it will outperform the market, and I have a high conviction. For Ingredient, its weight currently is about 12%. Using normalized 2021 earning of $6.2 per share, its PE is about 15.5. And its forward PE is 13, according to Morningstar.com. It has a narrow moat, and because of its relatively undervalued status, I believe it will keep up with the market under the risk-on scenario and outperform the market in the risk-off scenario. I have a high conviction as well. Next one is Emerson. It's only 1% of my portfolio. Its EV over EBITDA currently is about 15. According to Morningstar.com, it's 16% undervalued, and it has a wide moat. For similar reason of current valuation as well as the mode, I believe it will keep up with the market in the risk-on scenario and outperform the market in the risk-off scenario. I have a high conviction there also. One thing to note is that it's only 1% of my portfolio. So in a more balanced portfolio, that's probably too low. So I may make some adjustment next year to increase my portfolio investment in Emerson. For Walker Dunlop, it's 90% of my portfolio, and current PE is 17.5, and the EV over estimated 2021 EBITDA is about 18.3. It seems to me Walker Dunlop is fairly valued, and I cannot articulate if it has any moat. However, it has a track record of growing earning, and with the recent announcement of a major acquisition, I think it has room to grow its earning in 2022. So my prediction is that it'll keep up with the market in the risk-on scenario and outperform the market in the risk-off scenario. Since I cannot articulate its mode, but it has a strong record of growth, so my conviction level is medium. For Mercado Libre, it's 6% of my portfolio. Its price over gross earning is 22. So that number can be used to compare with the Amazon price over gross earning of 14. According to Morningstar, Mercado Libre is 50% undervalued, and it has a wide moat. Because of the high growth rate and the reasonable valuation, so I think in the risk-on scenario, it outperformed the market. But if it's a risk-off, then it'll underperform the market as a whole. And I have a medium conviction. For Emote, it's 4% of my portfolio, and the price over gross earning is about 19. The duration to parity is 6.5 years, with a revenue CAGR of 57%. And I believe it has a narrow moat because of its more advanced and superior technology. So for those reasons, I believe it will outperform the market in the risk-on scenario, but underperform in the risk-off scenario. And I have a medium conviction. Lastly, it's Amazon. It's 3% of my portfolio. As I mentioned earlier, the price over gross earning is 14. And according to Morningstar.com, it's 22% undervalued. So that gives me a benchmark to compare price over gross earning from other companies to Amazon. It has a wide moat. Amazon stock did not do that well in this year because it has been investing heavily in its people and logistics. I believe next year it will capture the benefit of the heavy investment made in 2021 and will grow and outperform the market in a risk-on scenario, but underperform in the risk-off scenario. And I have a medium conviction. For JFrog, it's 2% of my portfolio, and the price over gross earning is 17. And outside Amazon is the lowest in my growth portfolio. Duration to parity is 8.4 years because the CAGR is 40%. That's less than Emote. I believe it has a narrow moat. So for the risk-on scenario, it should outperform the market, but underperform in a risk-off scenario. Because the success of JFrog really depends on the adoption of the JFrog pipeline product and the CI/CD in the DevOps world. And I'm not an expert in that discipline. That's why I only have a low conviction. For Boston Bears, it's part of my growth portfolio, but because of its significant stock price reduction in this year, we can actually look at it from a value stock perspective. Its EV over EBITDA is 14.4 if I use my estimated 2022 EBITDA of $450 million. And that's pretty reasonable, or one could argue it's undervalued based on its 10-year revenue CAGR of 12%. According to Morningstar.com, it has a narrow moat. So I think in the risk-on scenario, it should be able to keep up with the market. But in the risk-off scenario, it should outperform the market. However, its key growth driver comes from non-beer products, especially hard seltzer. The consumer taste, how that'll materialize in 2022 is difficult for me to predict. Therefore, I only have a low conviction. In the risk-off scenario, my growth portfolio will underperform the market. However, that's only a relatively small portion of my portfolio, so my portfolio should be sufficiently defensive against it. In the risk-on scenario, I believe all my stocks will either keep up with the market in general or outperform the market. So I believe I have a diversified and balanced portfolio. One may wonder that since my high conviction stocks will either keep up with the market or outperform the market under both scenarios, why should I bother with growth companies? The answer is that I also need to keep a long-term return in mind. So the analogy is baseball. If you swing and try to hit a ball, you may either go for single or doubles. Those are incremental advancement. Or you may hit a home run, then you get a score multiple points. I believe the growth stocks have potential to score home runs, and my high conviction companies have less potential to do home run. It's also interesting to know that I have two stocks in Adcore and Energy Transfer. I believe they will do well regardless of what the market will do next year. And putting together, those two are 56% of my portfolio. And I have a high conviction in my prediction. Here is my action plan for 2022. So I plan to continue to hold the Adcore despite the concentration risk, since it's already more than 40% of my portfolio. The reason being is that I look at myself as a business owner. So Adcore has a very good business, making products currently in high demand, and there will also be a lot of demand from electrification in the future for its products. So its high concentration in my portfolio reflects its business success. In my opinion, it's still undervalued. So for a business owner, it would be insane for me to sell part of my business because it has been doing well, and I was still not offered a price that truly reflecting the value of my business. Another action I plan to take is exchange part of Yearend to Emerson. Yearend usually negotiates its pricing at the end of a calendar year. So hopefully it will see a significant price increase next year, and that will be reflected in its stock price. So if its stock price goes up significantly because of that, then I think it'll be an opportunity to exchange part of it to Emerson, because currently I only own 1% of Emerson in my portfolio. As I mentioned, I believe Walker Dunlop has some moat, but I cannot articulate that. So I plan to continue to investigate the moat of Walker Dunlop and increase my conviction in that company. Lastly, I plan to add more growth stocks to diversify my growth portfolio, because I don't use a stop loss to manage my risk. Therefore, it's important to manage my risk at the portfolio level by diversification and having more growth stocks. As shown on my previous slide, my conviction level for the growth companies are either medium or low. That's the nature of a growth company, because their valuations are based on future revenue growth. By definition, future are hard to predict. So thanks for watching the final episode in 2021. Until the new year, happy investing.